So Jason, how are you playing the China story right now?
Well, China, as always, is about policy, and then a bit more policy. And so what that does, it tends to make equities very volatile. So with China where we are now, we don't quite know which bubble the PBOC is trying to deflate next. It was property, and then they took some margin loans out of the equity market, which caused a bit of a ruckus earlier on, latter last year. So what we believe at the moment is that the PBOC are very stimulatory in terms of their local economy. We get that. But we're worried that they might have further action to deflate some bubbles within the equity market. So as much as we like the economy, we don't necessarily like equities. So we think the derivatives of China are a far less volatile and easy way to hold a China trade. So therefore we would like Aussie dollar, or we'd like some specific mining assets, or people that, you know, if we could think of like LVMH sells a lot of bags into China, we would kind of like those kind of trades as opposed to strictly owning Chinese equities themselves. The problem if you own a Chinese equity, you can have a heart attack owning Chinese equities. They're up 5%, they're down 10%, they're up 15%, and that's fine if you have the volatility tolerance. But I would imagine a lot of your investors don't. So I would prefer to have a lower yielding asset that gives me less heartache. And so therefore we much prefer the proxies of China as opposed to China itself.
All right, great stuff there. And Jay